answer. Tushar? Wait, first don't speak in Hindi. You have to speak in English. No. I'm not talking about, now we are talking about TAM versus AM. So TAM versus AM is we are in the world of asset management. So we are no longer in the world of corporate treasury risk management. That is the hedging context. Okay. Here too you might do some hedging, but that's not the primary focus of this kind of work. So I'm not asking you about, I'm talking about active versus, you can see one of the differences that we are going to discuss. We already discussed the difference between active and passive asset management in the last class of the previous course. And one of the points of distinction between TAM and AM is that the distinction between active and passive asset management, okay? So you can actually call this PAM and AM another time of, but let's call it active versus, because we are already using AM for alternative asset management. So active versus passive, okay, maybe I should put a bracket here, which is, you won't get attendance, it's your choice. Go to the cafeteria, has good coffee. Okay, active versus passive, what I should do is, I should put a bracket here, okay? It should be first bracket, but I prefer using the third bracket. So this is what I mean by the question, okay? This we already discussed in the last class. I'm just doing a recap. So what is one of the points that one of the ways that we are going to discuss, one of the ways we are going to distinguish between active and passive asset management, okay, is that one of the ways we are going to distinguish between TAM and AM, the ninth point of distinction is that the distinction between active and passive management is a relevant distinction in the world of TAM. But in the world of AM, it's not a relevant distinction. Okay, are you following? Okay, let me explain. Maybe it's a little bit complicated. Before we come to this point. So the point, what I'm saying, why is it a relevant distinction? Because in TAM, some of the managers are passive managers and some of the managers are active managers. So therefore, it is relevant to distinguish when you're looking at a particular asset manager, like Vanguard. You guys have heard of Jack Bogle, who died recently. You guys are not following financial news at all. Okay, I think in the last about 15-20 days, Jack Bogle has passed away. The very old, he was about 90 in the early 90s. So Jack Bogle is the founder of Vanguard. And Vanguard is one of the pioneers of index investing, which is essentially passive asset management. Index investing is a form of passive asset management. All this has already been covered in the previous class, okay? So Jack Bogle, you should know all this. So it just shows me that you guys are not tracking financial news in the way that you've been instructed to, because it's been there all over the financial industry, media, and you see tributes to Jack Bogle. Maybe just go and do a coup, because if you learn about what the contributions of Jack Bogle to the to financial services, you'll learn a lot about the growth of index investing. So that's another way of learning about it. So you should go and Google about Jack Bogle later on. Okay, so Jack Bogle is the founder of Vanguard. Vanguard is one of the pioneers of passive investing, which means you don't bother with all these kinds of high-flying portfolio managers. You just try to mimic the index. Try to invest in the broad index, okay, like the S&P 500, okay, or the NASDAQ composite, okay. So that the idea being that the idea there is that the ability to outperform the index is quite limited. You must have heard about this when you encountered mutual fund discussions. Have you come across this idea that most mutual fund managers, okay, all these high-flying portfolio managers who are managing their mutual funds, most of them do not manage to beat the index? Have you guys heard about this expression? Have you guys come across this idea? Yes. Some of you might have come across this idea, right? So this is quite well documented that most active managers, these are active managers. Again, you have to go back to the discussion of active and passive, which we had in the previous class, so we'll do that again. But most active managers do not manage to beat the index. Okay, it's a pretty high percentage, I think 85 to 90% of the managers. So therefore, the theory was that why should we, and remember we discussed in the previous class, I think Sena answered that question, which is that in what type of manager charges a higher fee, active manager or passive manager? Active managers charge higher fees. When you look at mutual funds, you have this concept of, remember this concept of expense ratio? This again was mentioned by Sena in the last class. Okay, this is the advantage of video. I can go back and see. It's easier to see what is being, who is saying what, etc. Okay, so now expense ratio is what you see. You guys should be familiar with all this. Okay, so expense ratio, when you discuss, when you go and do any kind of research on mutual funds. Okay, some of you might be doing your capstone projects on mutual funds and things like that. So if you do any kind of research on mutual funds, you will see that there's one way to rank the mutual funds is through expense ratios. Expense ratio is nothing but whatever you have invested in the fund. If you invested $100 in the fund and the fund has an expense ratio of $1, that means 1% of the assets under management out of your $1. That means the guy is actually going to manage only 99 cents for you. Okay, so what did I say? $100. Okay, so $99. He's going to manage only $99 for you, and that $1 goes straight into his pocket. That's his management fee. Okay, that's what the expense ratio means. That if you have a 1% expense ratio, you invest $100, the fund manager is only managing $99 of your assets. The $1 goes straight into his pocket as a fee. You're never going to see that again. Whether he makes money or loses money for you, you're never going to see that again. Okay, is that clear? So that's what the expense ratio means. So if you look at the expense ratios of mutual funds, you will see that active mutual funds, actively managed, these are called actively managed, and the others are passive. Okay, so the actively managed mutual funds will have higher expense ratios than the passive mutual funds, okay, or passively managed mutual funds. So this is one point that you see. The reasoning for that was also given in the last class when we discussed this, which is that because why do active managers have higher fees? You've forgotten the distinction between active and passive? Anyone?
The risk associated in the active asset management is much more higher than the passive.
Okay, it's not much more higher, it's much higher. Okay, but it's not, that's not strictly correct. It could be because you could have a higher chance of tracking error. In a sense, you're correct. But the main reason this is the answer, that one of the answers that came in the previous session as well. But the main reason that they have higher fees is that they are actually doing something, it's just like you go to a standard, if you go to a McDonald's, okay, if you go to a McDonald's, it's cheaper than if you go to you've heard of Michelin? You've heard of Michelin stars? Okay, so these restaurants are all, the top chefs are all given Michelin stars, right? So these, you have these high-tech, very hi-fi restaurants. They are, some of them have Michelin stars. Okay, so this is actually an index, okay, a way of ranking the chefs and the restaurants. So if you go to like a 4-star Michelin chef's restaurant, obviously the same amount of food that you eat or the same dish that you eat in McDonald's, if that guy, the 4-star chef, makes you a burger, it'll cost a lot more. Okay, so essentially it's a similar idea here. In active managers, what they're saying is that we are so good that we are going to outperform the index, which is the benchmark. Okay, so the index is really, we keep saying outperform the index, but what we really mean in general terms is we are going to outperform the benchmark. Remember when we had the discussion about looks like most people have not woken up today. Everybody looks kind of doped out. Yes.
Asset management, index wouldn't be the benchmark according to me.
Sorry,
in active asset management, and the index should not be the benchmark for the fund manager.
Yeah, I think you have a good point. What he's saying is that in active asset management, the index should not be the benchmark. Okay, the reason I'm saying that's a good point is actually if you see active management, one of the other things that we are going to say is that this is one of the biggest fund managers. You should also be aware of this company. This is actually probably the largest money manager in the world, BlackRock. Okay, they have, I think, something like $6 trillion. Okay, Achal is going to lose some points. I don't know what is happening. She's giggling for some reason. Who is sitting next to Tushar? No one. Okay, so Achal, you come and sit next to Tushar. We need to separate you from Sahil. Okay, so and then we have to deduct two marks for your team. Okay, so what were we talking about? So the point that Goel has made is a very good point. He's saying that an active manager should not be evaluated against a passive index. Okay, against an index. Okay, what he's saying, that's a good point, because one of the things, let me just take care of this little punishment routine. Okay, maybe I should increase the points now. -2 is not really hurting you guys, so I should maybe make it -4. How did this? Oh, I've opened the IFM CP sheet. This is the wrong sheet. Because I zeroed out all the marks from the previous sheet. No, again I'm going into. I need to go into FDRM CP. I've clicked on that now. There will be a problem. Okay, and please remember, guys, if you don't get the sharing mail by this evening, please by not even this evening, I should do it. If you don't get it by lunchtime, please send me an email. Okay, as soon as I go back from the class, I'm going to share all you guys into this folder. So. Okay, so Achal is opening the account. All right. Okay. So what do we say? Right. So if you see here, now let's go back to this point. So we are anticipating point number 9. Distinction number 9 is that the distinction between active and passive. We are in the world of asset management, okay? We're no longer in the corporate treasury risk management hedging world. We can do some hedging here as well, but mainly we are in the world of asset management, so I'm not going to repeat asset management every time. But the distinction between active in the TAM universe, the distinction between active and passive is a relevant distinction because some of the managers are passive managers and some are active managers. Like Vanguard, okay, is mainly known as a passive manager. All they have are index funds, okay? They're a very big manager. They have lots of, I don't remember the AUM for Vanguard, but it's very, very big. It's like Fidelity. It's one of the largest fund managers in the TAM universe. Okay, so now you have, so what we are saying is active versus passive. The distinction is relevant because some managers are active and some are passive, okay? But what we are saying in the case of AM, if you see, okay, in the case of AM, we are saying that the distinction, you can't read this at this point. Let me just, we are saying in the case of AM, we are saying the distinction is not relevant because in AM, everybody is an active manager. There is no concept of passive management in AM, okay? So therefore, an AM, as you guys should be aware, AM, loosely people use the word hedge funds to refer to AM, okay? So, but that's not a very good way to refer to it, but it's a short form, so people just use it instead of saying alternative asset management all the time. So hedge funds is loosely used to refer to alternative asset management, okay, or alternative asset managers. So here we are saying the distinction is not relevant because everybody is an active manager. So why is Goel's observation a very good observation? Because remember, when we discussed benchmarking, when we discussed the differences in benchmarking, in the case of TAM, the benchmark was typically the index, okay, which is I mean some kind of broad equity index, okay, or equity or bond index. You can have bond managers as well, okay. So it is some kind of index, which is like, let's take the example of equities, which is a very easy example. So if you look at BlackRock, okay. Why is this big ad coming? Anyway, so let's set up a comparison here. Compare, okay. So let's take BlackRock and let's manage it. Let's just check them against the S&P 500 and see how they've done, okay. All right, okay. So you can see it's difficult for you guys to make out the difference in the colors. But I can tell you that BlackRock is the S&P 500 index is in orange and the BlackRock is in red, okay. So BlackRock, over the period that we are looking at, this is what we call our investment horizon, okay, or our performance evaluation horizon, 2014 approximately till now, okay. And the index is down 56% and BlackRock is down 49%, okay. So BlackRock is going to say I'm a star because I have outperformed the index. If you remember that, we discussed this point, because they are always evaluated in TAM. They are evaluated against an index, and actually even active managers in TAM are evaluated against an index, okay. But this is the good point that Goel has made, that they should not be, because if they, to the extent that they are an active manager, okay, that means they're leaning more towards AM. Do you realize that? Because we said in AM everybody is an active manager. So do you realize that to the extent the TAM portfolio manager, like a typical equity or bond portfolio manager, to the extent that they are they are doing active management, they are leaning more towards AM because AM managers are active or are all active managers. Do you realize this point, Aryan? You're not clear. See, we are saying that all AM, let's just lose hedge funds also. Let's stick to AM. So all AM managers are active managers. We said that. So some of the TAM managers are active and some are passive. So what we are saying is that to some extent, to the extent that a TAM manager, okay, that is a traditional manager, okay, a mutual fund, is practicing active management, is it not more and more like a AM manager because all AM managers are active? Okay, in that sense. Okay, so in that sense, and remember that when you go to AM, remember for in the case of AM, we are using absolute benchmarks. We are just, you remember we had discussed the case of what is the investment firm of Howard Marks called? All these discussions which we are having in the classes, I don't know, you guys are not registering, even the exams. Oaktree, correct? So these are all very big investment managers. You guys should be aware, as part of your, as finance students, when you go out into the world, you should, and asset management is a very big sector of within financial services. So you should be aware, this is expected of finance students. If you haven't heard of the big players, it's like the guy who says, I'm interested in technology, and you ask him, oh, what is Oracle? You know, they doesn't know, he's not heard of Oracle, he hasn't heard of Apple, he hasn't heard of, Salesforce.com. So it doesn't make, it's not impressive. So you need to pass part of your knowledge, this is your contextual knowledge. You should know who the big players are in the different subsectors of financial services, okay? Right, so Oaktree is a very big distressed debt manager, all right? So remember we discussed that Oaktree works on an 8% hurdle rate. So whatever they make currently, their hurdle rate is around 8%. So if they make 38%, okay, they are going to get paid a certain percentage of that 30%. The benchmark is 8%. Okay, so they promise the investor that we are going to make it, if we don't make more than 8%, we are not going to take any money. Okay, they may have some management fee part, we'll come to that. Okay, so usually this, I don't know, we've discussed that, we'll just mention it. Okay, typically, we should just mention it here. Okay, so essentially let's assume that here there is no management fee. In the case of Oaktree, if they don't, what they're telling the investor is that if we don't make at least 8% return for you, we are not taking any money. Okay, unlike a mutual fund which is going to charge you that expense ratio anyway, whether they make money for you or lose money for you, the mutual fund is going to take that expense ratio anyway. Okay, so some of the asset managers, some of the AM managers will have only what is called an incentive fee. Okay, and so we can just write it here. This is not really connected. We can have this here. Okay, then we just say that the fees are okay. Yeah, I have it here. I've already written it here because this was prepared earlier. Okay, you can see the plus sign. Okay, so typically how the AM manager gets compensated is you have two components to the compensation. You have a percentage of assets managed and an incentive fee. Okay, commonly you will hear this expression called there's an expression which is here, which is very often used in the case of, I can't even see what I'm writing here. My screen is dirty. 2 and 20. Okay, so you'll hear this expression. Have you heard this expression before, guys? 2 and 20. Okay, what does this mean? 2 and 20 means, let's copy from here. So we are drifting around a little bit, but I mean we are looping inside the discussion because I was trying to explain this, and so 2 and 20 means, everyone understands the sign implies? Okay, 2 and 20 means 2% of assets managed. Assets managed, you understand? If I've given you $10 million to manage for me, that means I'll have to pay you 2% every year of the $10 million. That's just a management fee. Okay. Then there's the incentive fee. Okay, which is let's write it slightly differently. 2%, 20% of profits is the incentive fee. All right, okay. So 2 and 20 in the hedge fund world, okay, it means essentially this is a standard that a lot of hedge fund managers use, typically because every industry develops some kind of standard, right? Like in the real estate business, if you're taking a house on rent, typically you have to pay 1 or 2 months rent as brokerage, okay? So these kind of standards evolve in every industry. So here what they've evolved is a standard which many people use, which is 2 and 20, which is 2% of assets managed and 20% of profits, okay? But there are many fund managers who also try to distinguish themselves by deviating from this norm. And they say, like some managers like Tudor Investments. Have you heard of Tudor? So Tudor Investments started by Paul Tudor Jones. He's one of the legendary traders. So Tudor Investments has used to have, at least, I don't know whether they still have it, but for most of his career, he never charged any management fee. So his management fee was 0. So he would only make certain percentage of profits, like so 30% or 25% of profits or something like that. Okay. So this is, sometimes you can vary this, but 2 and 20 is that if you hear this expression 2 and 20, what it means is it's referring to the standard practice in the AM universe for managers to charge 2% of the assets managed and 20% of profits. Is this clear? So whatever profit I make, profits means, okay, you have to be aware that profits aware ahead of profits above A. This also you should be aware when you're looking at this. Entire discussion is on let me write it like this. In fact, you're not supposed to write it like this, but let's call it a high water mark. Okay. Okay. So profits above a high water mark, will explain what this high water mark is, but the general idea is 2 and 20 means I make 2% of assets managed, okay, and I also make 20% of profits, okay, and then you can vary this. So some people, as I told you, Oaktree, I don't know if they have a management fee, but they do have this incentive fee that they use a hurdle. So if they don't make more than 8%, they don't take any money. So if they make 38%, then they will take a certain portion of that 30% return. Okay, so that 30% return that they have made, they will take a certain portion, maybe 25-30% of that 30% excess return. Is this clear to everybody? You understood now what is the thing? Okay, so what we are saying is, say, by and large, this is a very good example of a typical of what is a classical benchmark in the AM universe. What Oaktree uses, that 8% hurdle rate that Oaktree uses, is a very good example of the classical benchmark in the AM universe. Okay, which means they set a particular hurdle rate. Okay, now it is 8%. Later on, it could change, and obviously it's related to the risk-free rate. So they set this benchmark, and anything above the benchmark they get credit for and they get paid for. Okay, so this is an absolute return strategy. Can you see that? Okay, it is, of course, you're comparing it to the benchmark, but you set an absolute benchmark. You don't set an index as a benchmark, because the index, you can see here in this particular example, the index is down 49%. Okay, sorry, the index is down 57% roughly. Okay, but this index can never be so this is the benchmark. See, here you have a situation where the index is the benchmark, the S&P 500, and the benchmark is down 57%. This is the difference between absolute and relative performance measurement. Okay, in a relative performance measurement situation in the TAM universe, your index can also be down if the stock market is suffering. Okay, then the index, as you can see here, that the stock market has got this negative performance. I don't know why this negative is coming here, because I don't know how they're calculating it, because overall the graph shows that it's up. I don't know. Anyway, we won't worry about it. We'll just see these numbers. But the point is that you can have, we can just make this a little bit different. We can change the, okay, now we can see, okay, see why is this ad coming? Anyway, so the point is that in the TAM universe, when you're using a benchmark, you're using an index as a benchmark, like the S&P 500, Nifty 50, okay, or BSE 200. If you're using any of these indices could be down for any period. You understand that? Just like the S&P 500 is down for this particular period, you can see. Okay, so therefore you can have this situation where in the TAM universe, where the benchmark itself is down. Okay, but in the AM universe, can you see this hurdle rate, for instance, example, let's say 8%. if we say oak tree has a 8% hurdle rate. So can this hurdle rate ever be negative? We have already set it at 8%. Okay, so it's fixed. So in this sense, we say that this is an absolute return kind of universe. Okay, here we are not comparing against a particular benchmark which can go up and down. So here in this sense, we say this is an absolute return universe because you're comparing against, and you're really trying to make as much as you can. Okay, as much as you can, and therefore you will get paid on the excess return that you make. Is this clear? Okay, all right. Yes, Ria, you have a question? Okay, all right. Okay, so the point I was trying to make is that, so it's a long answer to a long discussion on Goel's observation, but it's a very good observation that to the extent that a TAM manager is an active manager, he's behaving more and more like a AM manager, because in the AM universe, everybody is an active manager. And in the AM universe, we don't evaluate people against particular benchmarks, which can go up and down. We evaluate them against absolute numbers. Okay, so if you made 35%, you're better than somebody who made 25%. Okay, in that sense. Okay, so that's what we look at. We don't look at some kind of benchmark which can change in value. All right. Okay, so coming back to the distinction between active and passive, we are floating around a little bit, but we have to actually, this has already been discussed. Yes. Okay, so this has already been discussed in the last class. Remember, we all started this whole thing as a recap. So it's unfortunate that nobody seems to remember this very well. So the point is that active versus passive. So now this much you understand why the distinction is relevant in TAM, and it's not relevant in AM because everybody is an active manager. Okay. So now quickly to recap the difference between active and passive. Okay. You can actually go, and I'm not going to spend time recapping in detail because it's there in the previous video. Okay, in the last video of the previous course. So just check that. So in passive, okay, what you would do is that, remember, this is a TAM universe. So active versus passive distinction occurs only in the TAM. The question arises only in the TAM universe. Okay, so these are mutual funds, equity or bond mutual funds. Let's say that BlackRock itself is a mutual fund. Okay, so and BlackRock knows that it's going to be evaluated against the S&P 500. Okay, so one of the things that BlackRock, one of the safest things that BlackRock can do is it can just buy, instead of buying all kinds of, using its brain and trying to do all kinds of fancy things, it can just buy all the stocks in the S&P 500 in the proportions that they are present in the index. Is this clear? You understand what an index is? It's just an average. Okay, in this case it's a cap weighted capitalization. You understand market cap? Everybody understands market cap?
Yes, sir.
Okay, so it's a market, the S&P 500 is a market cap weighted average. One very famous stock index which is a unweighted average is the Nikkei 225. Okay, it's the most prominent index in Japan, but the Nikkei 225 is an example of an unweighted average. Okay, so they just take the 225 companies and they don't use any weighting or by market cap, or they just take a simple average. Okay, but things like the Nifty 50 and the S&P 500, these are all cap weighted averages, which means they have to weight it by the market cap. So if some stock has a higher market cap, that stock price will have a higher component in the overall, has a higher role in the overall value of the index. So one of the things what a manager can do is, if he's in the TAM universe, if he knows he's going to be evaluated against because both active and passive managers are going to be evaluated against a benchmark, which is the stock index, a broad stock index, okay, like NASDAQ, the NASDAQ composite, S&P 500. So one of the things he can do is, if his benchmark is the S&P 500, he can just mimic the S&P 500. You understand what mimicking is?
Yes.
Okay, whatever one guy does, the other guy replicates it. So you can just, what you can do is, everyone knows the composition of the S&P 500. Okay, so you can just buy the stocks and those particular stocks in that proportion in your portfolio.
Yes.
So, and that's a safe strategy, because there you can never have any kind of negative, you can't have any negative tracking error. You remember tracking error? All these things were discussed in the previous course. Now you've all forgotten. This is not acceptable for finance students, because if you learn these concepts, they should be with you for life. Okay, so tracking error is the extent to which you underperform your benchmark. All right. So some people say positive tracking error if you're outperforming, but I don't think that's a good way to use the word. So error is only on the negative side. Okay, so tracking error is the extent to which you minimize, underperform the index. So if you just mimic the index, then you can't underperform the index. Okay, but then you can't outperform either. okay, you're stuck, you're just replicating the index. So this expression again we discussed, this is called closet indexing. You remember this expression? Closet indexing, this is called closet indexing. So an active manager, what he does, so an active manager essentially does not do closet indexing. He makes active stock selection. So he looks at the benchmark composition on one side, okay, so he may have a chart on his wall saying, okay, this is the distribution of stocks in the S&P 500 in the following percentages. This is what the index is. This is my benchmark. But I think I can do much better than this. Let's suppose that Apple has, so one of the things he can do is, if the benchmark has certain stocks 1, 2, 3, 4 to 5 to let's say 500, okay, those, let's you serially number the stocks in the S&P 500. The benchmark has 1 to 500 stocks. So he can select some other stocks, stock number 603, stock number 750. So he can select, he can build a portfolio of stocks which none of which are there in the index, okay, because he thinks that all of those other stocks are going to do much better than the stocks in the index. That's one way he can outperform or be different from the index, okay. He can choose a completely different set of stocks, okay. And the other way he can do it is he can change the weights. So let's say Apple has a 2% weighting in the S&P 500, let's say, just as an example, okay. But this fund manager, if he wants to be an active manager, one of the other ways in which he can be an active manager is, even without changing any of the stocks in the index, he can have the same stocks as are present in the index, okay, or bulk of the same stocks. But he can radically change the weights. So let's say Apple has a 2% weighting in the S&P 500, but this guy, the fund manager, who, if he thinks that Apple is going to do much better than the other stocks in the S&P 500, he can make Apple 45% of his portfolio. He can invest 45% of his portfolio in Apple. Now already he has become an active manager. Even though he's not actually changing the stocks that are there in the S&P 500, he keeps the same stocks, but he plays around with the proportions. Okay, Apple is 2% of the S&P 500, let's say, but this guy makes Apple for 45% of his portfolio. Okay, because he thinks Apple is going to do much better. Is this clear?
Yes.
So these are all the ways in which you can be an active manager. And a passive manager is evaluated against indices like this, like the S&P 500. Active manager, what he does is he basically says that I don't have to blindly mimic the index. I'm going to be different. Either I'll choose different stocks or I'll change the weighting of stocks in the index. Is this clear? All right, so this is the difference in active and passive. So now, as we said, so we've covered one more point. That now we've essentially covered point number 9 as well. Okay, that in active, in TAM, there is a distinction between active and passive, which is a relevant distinction, because when you see a TAM manager, one of the questions you have to ask is you have to find out whether this is an active manager or a passive manager. Like I told you the story of Vanguard. Vanguard is essentially a passive manager. Okay, where if you look at Fidelity, for instance, Fidelity is more known as an active manager. Okay, so one of the famous, have you guys heard of Peter Lynch? Peter Lynch wrote this book, which you guys, anybody who's interested in equity investing should read this book. It's called One Up on Wall Street. Okay, so Peter Lynch is one of the well-known equity mutual fund managers. So he managed the Fidelity Magellan Fund. You know who Magellan is? Magellan is, I think, is a Portuguese. He's like Columbus and all, Vasco da Gama, all these guys who used to go sailing around the world. So Magellan is a famous explorer. So the Fidelity Magellan Fund was managed by Peter Lynch for I think almost 15 years or something, and he significantly outperformed the S&P 500 index. Okay, so he's known as one of the greats of equity mutual fund investing. All right, so Fidelity, he was with Fidelity. So Fidelity is more known as an active money manager. Okay, so the distinction between these is relevant in the TAM universe, but it's not relevant in the AM universe because everybody is an active manager. Okay, now one of the things that you have to be aware of is, I'm going to put it here itself, as students of finance in this day and age, you should be aware of this very important trend, okay, which is, it's actually a very significant shift, but I'm just going to write it as a shift. Okay, shift from shift of, it's not very well written, but I'll explain to you what this means and you should understand this writing then. AUM from, what is happening? We are saying that in the context of the discussion between active and passive, there is some kind of shift happening in the AUM. What kind of shift is happening? Can you guys guess? Have you heard of any of this? This is another indication that you guys are not doing enough. You're not surveying the industry, you're not tracking the news properly. If you were listening to Bloomberg TV regularly, you would have heard these kind of discussions. One of the trends that's going on in the industry for the last almost a decade now, okay, what is happening? There's a trend that lots of money is shifting from either from active to passive or passive to active. So what is it that's happening?
Active to passive.
Active to passive. Okay, so this is the correct answer. So what are the trends that you have to be aware of, because you're operating in the industry now, you're going to be graduating now, and as trends emerge you should be aware of them. So one of the very big trends in the asset management industry globally is the shift from active to passive. Okay, as more and more mutual fund, more and more evidence emerges that active managers are not able to outperform the index. So active managers are doing kind of like this, okay? Like, okay, here they have outperformed the index because they're down 4.5 and they're down 6.5. The index is down 6.5. But if it were reversed, okay, most of the time you're finding that active managers are not able to outbeat the index. That is the benchmark. The equity index in this case is the benchmark. Okay, so you're not able to beat the benchmark. So, and remember one thing, that active managers, remember who charges higher fees, active or passive? Active. Okay, so A, you're charging me higher fees, and B, your performance is worse than the benchmark. So why should I invest with you? Okay, so this is one of the elements of logic that is driving investors from, and is leading to a huge flight of capital from active to passive funds. Okay, so this is something that you have to be aware of. And then sometimes you'll see ebbs and flows in this kind of thing. When active managers outperform, then some money may flow back into active, etc. But there is an underlying trend to move money from active to passive, because passive management is much cheaper. Okay, and you can mechanize it much more. Okay, all this.
Can we say that
Use the mic, since we are not. Where's the mic?
Sir, I don't need to.
No, you don't need it, but let's use it. Okay, give him the mic. It'll slow us down a little bit, but let's use it. Yes.
So can we say that the global financial crisis are also a reason for this?
You could say that. That's also a very good point, actually. That what Tushar is saying is that the global, for this shift that I'm talking about, the shift of capital from actively managed funds to passively managed funds, whether it was also caused by the global financial crisis, and it's actually very true. Okay, you're very right there, actually. That see what happened in the as a reaction to the global financial crisis. Now, this is something else you guys should have read up on. Have you guys got your textbooks, this Hull and Basu book?
No.
Not yet? Okay. So when you get the textbook, in case I forget to mention it once again, there's a very good chapter in the Hull and Basu book on the global financial crisis, okay, which is, we normally refer to the 2008 crisis, okay, the September 2008 bankruptcy of Lehman Brothers, and then that's when things started to get really bad. So what happened as a result of that GFC is that central banks worldwide, I hope some of you guys are aware of this. What was the response of central banks? Did they cut interest rates or raise interest rates?
So they
Cut interest rates, okay. Now, which countries now, what kind of interest rate what is the ECB's policy rate right now?
0.
It's not 0, it's actually minus 40 basis points, right? So it's actually sub-zero, actually, minus 40 basis points. The Bank of Japan also has negative interest rates. On some part of the reserves, they're getting negative interest rates. So these are two very prominent economic blocks, Japan and the EU, which still have negative interest rates. But you're right that the general monetary policy response to the GFC was aggressive cutting of rates, very aggressive cutting of rates, driving rates to near zero. The Federal Reserve is a central bank for which country? US. Okay. So the Federal Reserve came down to near zero. They didn't go to negative, but the EU went to negative, ECB went to negative, BOJ went to negative. Since smaller countries like Denmark, Norway, they also went into negative. Okay. So, but they're much smaller countries. But generally the idea was central banks were doing negative interest, they were engaging in negative interest rates, basically implementing negative interest rate policies or very low interest rate policies. And then they came up when that was not sufficient to What is the problem, Sahil? We'll have to cut marks for Sahil. You may be from the same team. Are you from the same team? What is the problem? Let's remove him from the danger position. Let's put him somewhere else. Why don't you come and sit behind? Come and sit behind the Ridhima, so you'll be away from your buddies. You'll be a little isolated. Okay. All right. Okay. So which team are you in? Same team. Great. You're really running away with the trophy. Okay. Okay. So there is a shift of AUM from active to passive. Okay, this is something you should be aware of as a major trend. All right. Okay. So what was I saying? And so it's a very good point that Tushar has brought out, which is that this shift was accentuated. Try to understand this. This is a slightly subtle point. If you don't pay attention, you will not understand it. Okay. What happened was, so the central banks, in response to the GFC, what they did was they aggressively cut interest rates. So every central bank around the world, in India also the same thing happened. They aggressively cut interest rates, maintained very low interest rates. Okay. In addition to that, some of the major central banks like the ECB and the Federal Reserve engaged in what is known as quantitative easing. Okay, let me write this all here itself in the discussion. Now maybe we should write it in the notes. Yeah, okay, let's put it here. Okay, so let's put it under, this is a very important topic as well. Okay, try to read up on this if you can. I'm not going to write perfect English, so I'm not going to write the GFC. I'll just write GFC. Okay, monetary policy response to GFC. 0. Okay, this is another acronym that you guys should be aware of as finance students. ZERP. ZERP means zero interest rate policy. Okay, or NERP. What is NERP? No interest rate policy. Negative interest rate. But no interest rate is better than negative interest rate. Negative interest rate policy. Okay. Okay. Then what happened was, so obviously, if you cut interest rates, you would expect economic growth to be, to respond positively or negatively? Positively, right? Because you're reducing the cost of borrowing, so making a lot of more projects are viable now. Okay. So negative interest rate, lowering interest rates normally would have a positive impact on growth, because what happened as a result of the GFC was there was a massive sentiment shock to the market. Okay. There was a massive credit shock, and lots of banks were pulling credit because they lost a lot of money in the mortgage-backed securities, okay, which were mainly involved in the financial crisis. So therefore they started, because of the large losses that they suffered, they started pulling back on credit. Okay, so therefore the government wanted to encourage them to lend, and therefore they wanted to increase the demand for loans. And one of the things they did was cut interest rates, but even that did not work. Okay, even as a response to lower interest rates, growth did not pick up. It took a long time, so growth was not picking up. So as a result of that, in around, I think, 2013-14, central bank started what is known as quantitative easing. Okay, so let's talk about this. Have you heard this term? QE. This is called QE. Have you heard this term? Okay, you should have heard this term by now. Okay, these are all important terms. That's why I keep telling you guys to watch Bloomberg TV all the time, at least 1 hour every day, because you're going to hear a lot of terms that you don't know, and then you can read up on them, or you can ask me in the class. That's how you increase your knowledge. That's why I gave you this formula, but your program is almost over, and none of you guys have been following up on the recommendations. Okay.
So, but lowering interest rate will increase inflation rate.
That's also a good point, but that is a chance that they took. They figured that in this environment, because remember the central banks, you understand the point that Satyam has raised? That's also a very good point, that lowering interest rates will risk higher inflation. Okay, So essentially what they did was, if you put this in a little bit of a block here, we can just take this as, so if you look at the central bank, CB I'm writing for central bank, okay, or let's say the central bank mandate. The typical central bank mandate is, I'm giving a long answer to, long response to Satyam. Typically it is, promote economic growth. So like, what is the US Federal Reserve? You understand what the mandate is? Mandate means this is what you have to do. This is your role, okay? When a central bank is set up, this is your role. The central bank is told by the government that this is your role, okay? It's usually controlled by the executive branch of the government. You remember the three branches of government? Executive, legislative, and judicial, okay? So the executive branch typically nominates the head of the central bank. As you can see here in India as well, we had this recent change in the RBI governor. So which branch of government appointed the governor? Executive branch, because the government in power, okay?
But
so
the act of RBI is formed by the legislature.
yeah, the RBI Act is formed by the legislative branch, but it gives a lot of power to the executive branch. If you read the act, through the act itself, the executive branch of government is empowered to essentially manage RBI on a day-to-day basis, okay? But you're right that the act is drafted by and passed by the legislative branch, okay? So typically the central bank mandate, once again a long response to Satyam's point, okay? His point was that cutting interest rates, why did they cut interest rates? Because it might have increased inflation, okay? So typically their mandate of a central bank, you take the US Federal Reserve as an example, okay? Most central banks have this kind of a dual mandate, okay? Typically a dual mandate, these are all terms, okay, that you have to, which is, dual mandate is, one is promote economic growth and two, control inflation, okay? What kind of mandate does the Reserve Bank of India have? Is it dual?
Dual. Yes. Sir, at present it is controlling the inflation only.
Okay, so strictly speaking, if you look at the Reserve Bank of India, the RBI mandate, it is not a dual mandate. Okay, this was formalized by Raghuram Rajan when he was governor.
Yes, but now
that
it is converted to dual mandate.
Yeah, so effectively what happens is, because the executive branch of government, which is the government in power, okay, because they want to promote growth and inflation is less of a concern, okay, they always want to promote growth because they have to worry about the next election and things like that. So there's always, you can see the same problem happening, the same situation in the US and India. You know that Trump has been very critical about the Federal Reserve raising interest rates, because the US Fed has been raising very aggressively, and he's worried that this will dampen economic growth. Okay. Increase the cost of borrowing, and they have increased quite dramatically. Actually, they're doing three things, which is a more involved discussion. They're actually cutting down their bond purchases, that is withdrawing QE. They're removing something called forward guidance and moving to data dependency, and then they're also raising interest rates. So this is actually a three-pronged rise in a tightening of financial conditions in the US. So if you look at the performance of the US economy in the face of all this headwind, it's actually quite phenomenal. You imagine what would have happened if they had not moved on interest rates. The US economy has been very, very strong. And that's partly, I think, mainly driven by deregulation and tax cuts. Okay, which I wish our policymakers would take a leaf out of that. We could also enjoy that kind of growth. But anyway, and two is control inflation. So what Satyam is asking is, so this is a typical mandate, but you should be aware that the Reserve Bank's formal mandate is only for controlling inflation. Okay, 4%, I think it's 4% plus minus 2, right? All right, so that's a unique kind of mandate because it's focused only on inflation control. Okay, similarly, before the Eurozone was formed, the Deutsche Bundesbank, which was the central bank for Germany, okay, they still are the central bank, but the policy is run by the ECB. The Bundesbank was well known as a central bank that focused very much on inflation control, and they were not so worried about growth. Okay, they were mainly focused on inflation control. But the US Federal Reserve, the most important central bank in the world, has to worry about both aspects. All right. So what Satyam is asking now, why did they do that? Why did they cut it? You're right, that if you cut interest rates, it is mainly seen as a risk that, I mean, this creates a risk that there might be very high inflation. It might lead to high inflation. But the reason they didn't worry about that side, so obviously it's a delicate balance. If you have to promote growth and control inflation, in order to promote growth, you need lower interest rates, or it helps to have lower interest rates. Okay, but
Trade-off thing.
it's a trade-off. Okay, it's a trade-off. So there is a trade-off involved here, because in order to promote growth, it helps to have lower interest rates. Okay, now again, Dina and Ria will have to lose marks. Ria is also in your team.
Yes, sir.
There's some discussion going on there. If you are not interested in what's going on in the class, then you can put your head down and sleep. That is always, you are always welcome to do that. No, you are listening to Dina, not to me.
But I was listening now to you.
So you're looking at her and smiling and listening to me. Okay. All right. Okay. Where is the team? Ridhima. So you also opened your account. All right. Okay. So what discussion are we having? So now the point is, so what Satyam is saying, so as there is a trade-off involved. Okay. So if you raise interest rates, you will be able to control inflation. But if you cut interest rate, but you might choke off economic growth because interest rates are too high. But if you try to promote economic growth by cutting interest rates, you may risk raising inflation. Okay. So there is a delicate balance to be maintained. So essentially, what they decided is they decided to lean in favor of stimulating growth. Because at that point of time, if you looked at the market mood, Lehman Brothers had just declared bankruptcy, which was a big surprise to the market. Okay, the market wasn't expecting it, and there was a lot of other problems with other firms as well. Merrill Lynch had to be taken over. Okay, Goldman Sachs, Morgan Stanley, who were not really in any trouble, but there was so much panic in the market that they had to go and register themselves as banking companies. Okay, they were standalone investment banks, but they had to go and register themselves as banking companies so that people would feel that they are banks now and they have the support of the Federal Reserve as an umbrella. Okay, so that kind of confidence, even firms like Goldman Sachs and Morgan Stanley, which were really blue chip investment banks, the market panic was so high that even those kind of firms had to go and seek the umbrella of the Federal Reserve and become banks. So in that kind of environment, the central banks believed that the much greater risk, going into a deflation, that is a period of a recession or depression, that kind of situation, going into a deflationary spiral and a negative growth spiral was a much higher risk than the risk of high inflation. So that's why they did that. Okay, it's so you understand now. Okay, so we have these long discussions so that you can understand all the points around the question. Okay, so the other thing that these guys have done is we are still answering, we are going back to the higher loops, we are still answering Tushar's question. We are still responding to Tushar's point, which is a very important point, that the flight of capital from active to passive. Why is this happening? One of the things that has driven it is the global financial crisis, but how exactly? And that's what we are discussing. Okay, in discussing that, we were just going into central bank policy making. That's when Satyam came with this question, so we went into a detail of that. Okay, so now we are going back to this. So one of the things,
Going to it active to passive, it should be gone to active to bond market instead of.
yeah, there was if you look at the bond market situation, for instance, if you remove this, where is the delete option? I don't think I clicked on remove option. Okay, so if you go to TNX, which is the index for the 10-year treasury yield. Okay, we're still far away, we won't be able to go there, but yeah, what you're saying is correct, that you could have also gone into the bond market, which is basically safe government bonds, gone into government bonds. In a time of crisis, one of the things that happens is that there is a flight of capital into government bonds. Okay, so that is one of the things that
interest rate decreases at the time of crisis or increases at the time of.
In what you tell me, what is going to happen? You tell me. Should interest rates decrease in a time of crisis or increase?
Decrease.
Down or up? Down. Okay, because decrease, increase, I can't make out the difference. Okay, so it is down actually. Okay, if you look at this ugly little ad which keeps coming, now it'll tell me hide for now. Okay, so if you look at this time here, okay, there was a brief period of increase, but more or less if you're looking at September, 2008. Okay, this is September, 15th September, I think, is the Lehman bankruptcy. So after that, you see the US government bond yields have gone down. Okay, so government bond yields went down, which means what happened to government bond prices?
Increase.
Increase. I'm not getting a thumping response from the whole class. Well, yes, Kriti. If government bond yields went down, then what happened to government bond prices? 1 minute, let Kriti answer. Increase. Up or down? Okay. No, I can't hear the difference between increase and decrease. Okay, because it's kind of hard to make out. Okay. So, therefore, please remember these basic things. Okay. If somebody asks you in an interview, a finance student, and you don't know the relationship between prices and yields, okay, it's kind of embarrassing. Okay. So, yes, in a time of crisis, you will see government bond yields, because remember, bond markets, normally when we track bond markets, we don't track them. When we track stock markets, we track them by prices. Okay, if you're tracking stock of Apple or Microsoft, we track the price of the stock. In the case of bonds, we don't track the price, we track the yield. Okay, that is the convention. So, therefore, you'll see that yields will typically fall in a time of crisis. Okay, so you're right that there's typically, this is called a flight to safety. You might hear this expression.
Yes.
This is called a flight to safety. When there's a period of crisis, people will jump into buying of government bonds. Okay, investing in safe haven currencies like the US dollar, Japanese yen, Swiss franc. These kind of currencies will involve. I don't know if the Swiss franc can still be seen as a safe haven.
Why? Why?
Because the Swiss central bank has been following lots of stupid policies. Actually, they have come up with negative interest rates. They're really kind of not managing the reputation of the Swiss franc very well. But anyway, so this is the situation. So, but yeah, coming back to that, so you have a point, but remember that those who are equity investors, because remember this concept of, some of you are going to do financial planning, like Bhupesh, Ria, some of you are in what? You're not going to take up that job. Financial planning in the sense, you're going to be planning portfolios for investors. What happened, Ria? You're not taking that job.
I'm not sure about it.
Okay, fine. But anyway, you got that job as a financial planner, financial advisor. What these guys do is typically they design portfolios for investors. Okay, so they would be dealing with retail investors and designing their portfolios based on all this life cycle theory, that if you're a very young person just starting out, you can have more money in equities and less money in bonds. But as you approach retirement, you should have more money in bonds, because bonds offer you a safer return. Okay, it's not a very intelligent approach according to me, but this is the conventional approach. So you need to know about this. Okay, yeah.
So reason?
No, that I'll tell you later. I don't know, because first I have to teach you the mainstream ideas. Okay, so later on my unconventional ideas that we can do later. But first you have to know the mainstream approach. The mainstream approach is to say that so you distribute your assets into equities and bonds. Okay, so therefore those who are, the reason it doesn't go fully into bonds is because those who are actually let's say young people who want to invest more in equity, who need to invest more in equities, because equities historically offer higher returns. Okay, so if you go completely into bonds, you may be safer, but your returns will diminish. Okay, so it doesn't go fully into bonds. It went into passive. Why? Because now if you go back to the central bank monetary policies, okay, so what they did was, first they went in for ZERP or NERP, okay, but that what happened was, even after that there was no impact on growth. Growth did not pick up. Okay, so therefore what they started to do was quantitative easing. Okay, I'll give you guys a good write-up on quantitative easing. You can read it. I mean, a reasonable write-up. But essentially, what is quantitative easing? It's just buying bonds to pump money into the economy. You are already familiar. Have you guys done in your banking? You know how monetary policy is conducted?
Yes, sir.
Through repo transactions.
Yes, sir. Open market operations.
Open market operations. What is happening in an open market operation? What is the central bank buying? Bonds. Okay, and what is the central bank selling? Currency. Okay, remember, every market, that's also an instrument. Repo is an instrument. It's a market essentially. All right. So there is, how did we define a market?
Exchange of
It's a venue for exchanging two assets. Okay, exchanging assets are and usually you'll have two assets which are exchanged. Okay, sugar is exchanged for Indian rupees, dollars are exchanged for yen. Okay, Microsoft stock is, common stock is exchanged for US dollars. This is how a market operates, and you change any of the asset, it becomes, if you change any of the assets, it becomes a different market, right?
Yes.
Okay, so therefore in the repo market, what is happening is, what are the two assets?
Sir.
bonds and the security.
Let's just test the very basic concept we are testing. In the repo market, now we have defined market in a particular way, which you will not find in any particular textbook, but this is the correct definition. That a market can be defined as a venue for exchanging any two assets, okay, or exchanging.
Interest rate for the two assets.
So, everyone understands the repo transaction,
Yes, sir.
Yes, sir.
okay? Kriti, you're not clear about repos. You don't understand repos, okay? So everyone understands repos, Akanksha? Understand repos? So now tell me, based on your understanding of markets, you also understand what a market is, the way we have defined a market. Now tell me, in a repo transaction, in the repo market, let's say the repo market in the US, in a repo transaction in the US involving, okay, I won't say what, but in a repo transaction in the US, what are the two assets?
The dollar and bonds.
Correct. So it will be US dollar. Any local currency in India, that US dollar will change to Indian rupees. Okay, so it will be dollar and a bond. Okay, to be more specific, because bonds are only one class, so you should say a debt security. Okay, because it could technically be done through a bill also. All right, so that's not a bond, because a bond is what? What is the difference between a bond and a bill?
So bond is for time periods.
Yeah, so initial maturity is more than 1 year, and what else?
Zero.
You're not confident about the answer. So the other difference is what?
Reference. No coupon rate. The reference.
So there is no coupon in the bill. A bill is a money market. So first, the way you should approach it. You guys are all clueless about your basics of finance. I don't know why everybody looking like. Am I sounding like a zombie to you or what? Have you not understood the question?
Yeah.
So these are very basic questions. What's the difference between a bond and a bill? So the way you should answer this mentally in your mind is, you should immediately remember that a bond is what is in the bond markets, is a bond market instrument, because we had divided debt markets into two parts: money markets and bond markets. Okay, in some other books you'll find some other kind of classification. That's not correct. Okay, you go with this classification. Okay, and I gave you the reason for that as well, why it's not correct. So some people say money markets and capital markets. That's not correct. Okay, so money markets and bond markets. And what's the distinction? So straight away when I ask you the difference between a bond and a bill, you should remember the higher level categories: money markets and bond markets. And in the bond markets, what do you have in the bond markets?
Initial maturities.
Is more than 1 year, and
And there is a coupon rate in bond.
the word that you should use, there is a discrete coupon. Okay, where there is and in the case of money markets,
There is no coupon rate at the initial maturities.
initial maturity is less than 1 year, and there is no coupon rate. The securities are sold at a discount to face value. Okay, this is how you should answer the question. So you should immediately remember, when you get a difference between these two two categories, you should remember the larger families to which they belong. Bonds belong to the bond market, bills belong to the money market. And then what is the difference between bond market and money market securities? Same thing will apply. Say now you can apply the distinction, like Giri asked me a question once: what is the difference between futures and forwards? Okay, so if you have a question like that, straight away you should understand what is forwards are what, OTC or exchange traded?
OTC.
OTC. Forwards are OTC instruments, futures are ETM. Okay, so therefore immediately all the distinctions that apply between OTC and ETM will apply to forwards and futures. That is one way. That is the right way to approach the distinction, actually. Logically correct way to approach it in your head. Is this clear? Okay, so quantitative easing now, remember. So therefore now everyone is clear that in a repo transaction, remembering our basic definition of a market as a venue for exchanging two assets. In a repo transaction, what gets exchanged is, one is a debt security and the other is some currency. So in the US it will be US dollars, in Japan it will be Japanese yen. Okay, local currency essentially. Okay, so therefore this is the exchange. So in a repo transaction, when the central bank is adding funds to the system, when the central bank is adding funds to the system, what is it buying?
The bonds.
It's buying the bonds. Okay, the first leg. In the first leg, it's buying bonds, because repo, remember, is repurchase. You know the full form, right? I hope you know the full form of repo. Repo is the US pronunciation. Here we say repo rate, but it's better to say repo because that's a global convention. Okay. So repos comes from repurchase agreements. So it's not a one-sided transaction. Okay. It is typically a case where when the government is adding funds, in the first leg they will buy the bond. Okay, which means the dealer is selling the bond. And then the government, in the second leg of the transaction, the government will sell back that bond, okay, at a higher price. Okay, and that higher price is the interest differential. That is how you get paid for lending the money. And it is buying in the first leg. What is happening is it's buying the bond and it is selling the cash. Okay, selling the local currency. Is this clear? Okay, so this is what they were doing in a repo transaction. So the same thing in quantitative easing. What you do is essentially you just buy bonds outright. Remember, this is a repo position is like a spread position. Remember, a repo position has how many legs? Repurchase. Repurchase is not just a purchase, it's a repurchase agreement. Okay, it is, I agree to repurchase. I'm selling you the bond now. The dealer says to the central bank, I'm selling you the bond now, but I agree to repurchase. That's why it's a repurchase agreement. Okay, so I agree to repurchase the bond after 2 weeks at a higher price and thereby give you the interest compensation. So the central bank will buy the bond at 100 rupees and it will sell the bond at maybe 102 rupees. Okay, after 1 week or after 2 weeks. That's a very high interest rate, but that's how they'll get compensated on the interest part. Okay, that's how they get paid their interest, because the dealer buys back the bond at a higher price. Okay, so now this is a spread position. When you have a repo position, you have a spread position. It's essentially an interest rate position. It's a way of financing your fund requirement. Okay, so it's a spread position. You remember the difference between outright and spread positions?
Yes, sir.
Yes. Okay, Sahil just woke up and remembered the difference. Okay. Okay, so outright and spread position, a repo is a spread position. If you have a position in repo, it's a spread position. But now imagine this as an outright transaction. In quantitative easing, what the central bank is doing typically in a classical QE transaction, they are just buying bonds outright. And so if the central bank is buying bonds, what is it selling? Currency. So in India, the RBI is buying bonds. If the RBI, they didn't do QE in India. But let's take the US Federal Reserve. So with Federal Reserve, when it's doing QE, what it's doing is outright bond purchases. So the Federal Reserve just went into the market and bought bonds. So if they bought bonds, what do they sell? US dollars. Okay, so if the central bank is selling US dollars, what is happening to the money supply?
Will increase.
Increasing?
Increase.
Okay, so if increasing money supply typically has what kind of impact on the interest rate?
Sir, increase.
Down or up? Interest rate down or up?
Up.
Down.
What is, some are saying down, some are saying up. Think of it this way.
So money supply increases, interest rate
Decreases.
Yeah, and so what is the logic? How will Pranav explain that money supply, no, he said down. He said the interest rates will go down if money supply increases. So how do you explain that? Suppose I'm an idiot, I don't understand. Explain it to me. 1 minute, let Pranav explain. Give him the mic.
So if in the market there is more money in the market, so there is a more purchasing power by
Don't keep saying more money, more purchasing. More money in the market.
in the market, so there will be more purchasing power by the customers. So the inflation rate will go up. So to get down the inflation to normal, so the bank rates will increase the interest rates.
Will decrease the interest rate.
Increase the interest rates.
No, but initially you're now contradicting yourself. Okay, all right, okay. No, so anybody else wants to explain? Yes, Achal, you can redeem yourself after losing 4 points. Yes. Why should, the question is, why should interest rates go down if the supply of money increases? Ceteris paribus, remember that expression? Okay,
So
yeah.
because people will have
Yeah.
more money to save in the bank, and so bank.
Mic is not being used properly. Hold it closer to your mouth. You have to understand all these things, yeah.
So people will have more money, so they'll deposit more money in the banks, and the bank will offer less interest rate on the money saved or money deposited by the people.
Okay, so this is a much better explanation, closer to, see, simply just think about it this way. Ceteris paribus, when supply increases, what happens to price? Price goes down. Okay, let's say up or down instead of increase, decrease. So price is down, If ceteris paribus, if supply increases, price goes down. Okay. Now, what is the interest rate? Is it not the price of money?
Yes, sir.
Interest rate is, can we see the interest rate as the price of money?
Yes, sir.
Okay. So if the supply of money goes up, then what should happen to the price of money?
Should go down.
Down. So the interest rate goes down. Okay. So Achal has given you a more detailed explanation that essentially if you have excess supply of money, okay, there are more people willing to lend. In a way, you can think of it as more people being willing to, there's more supply of loanable funds. And so if there's more supply, then the price should go down. And what is the price of money? It's interest rates. Okay. All right. So let's, now have you understood this point?
Yes, sir.
So quantitative easing, and now first understand, because it's a new concept for you. And these are very important concepts in finance. In this modern age of finance, this QE business has come into the picture only after the GFC. Okay, only after the GFC. First, the central banks tried to aggressively cut rates down to zero, and then some of them went into NERP. Okay, but that also was not enough to stimulate growth. So these guys are panicking. What do we need to do to more stimulate growth more? So they decided to flood the system with money. And how did they do that? They did that through QE. QE means outright, not a repo transaction, which is a spread transaction. It's an outright purchase of bonds. Just go into the market and sweep up bonds. These Japanese central bank, they've gone completely loco. They have started buying equity securities, ETFs, mutual funds. So essentially the central bank goes in, but typically QE works classically is understood as operating on debt securities, starting initially with government securities, but the ECB has started buying even low grade company debt. Okay, so even my poor grade company, I mean basically not highly ranked debt. So the central bank goes in and starts buying bonds in the system. So if the central bank is buying bonds, means it's selling currency. So the system is getting flooded with more and more cash. So that will hopefully have an impact on interest rates and bring them further down. Okay, or at least it will encourage people to be more aggressive in risk taking, because that's what they wanted. They wanted to stimulate risk taking and stimulate economic growth. Okay, so this is QE. And they also did a third thing, which is, so as a result of this, okay, before we get into the third, so coming back to Tushar's point, why did this flight from active to, as a result of this kind of aggressive monetary policy movement, okay, what happened was that if you look at these asset prices, okay, if you look at asset prices, like all these, let's say, look at any particular stock, okay, okay, let's just look at, as a result of this kind of, you've seen a dramatic rally in equity prices, okay. So this is say from 2008, this is the 2008 bottom, all right, this is the 2008 bottom. Now this dramatic rally in equity prices, you can see this in almost any country in the world, okay. This has happened partly because of tremendous pumping of money into the system. Liquidity into the system has been, and where will the liquidity go? They go and buy risk assets, because the central bank is essentially saying that we are standing there as a backstop to give you lots of money. We'll pump the system, we'll flood the system with money. So this encouraged people to go and take all the excess money, invest in stocks, risky securities, and drive up the market. But as a result of this, what happened was that normally stocks are driven by many types of factors. Technological change, like what is going to happen to Tesla, battery technology, this, that, adoption of this, that technology, all kinds of uncertainties drive. But what happened because of this kind of aggressive monetary policy movement measures was, what happened was that this monetary policy became the #1 driver of every asset price. Okay, to understand this point, it's a little subtle to understand, but essentially that monetary policy became so dominant because the system was flooded with so much money that all other factors driving stock returns and asset price returns, well, basically they got pushed aside. So excess supply of money was driving everything. So as a result of which, active managers found it very difficult to outperform the index, because the flooding of money was driving up asset prices everywhere. So everything became very correlated. Okay, you understand correlation? So when do active managers do well? Suppose you're smart enough to understand that there's this company called Netflix which is going to become a big tiger in the streaming space, and you invest in Netflix at an early stage, and you're able to enjoy the outperformance of Netflix compared to others. But if everything is going to start, so when there's a variation in performance, that's when active managers can do well, because you're smart enough to pick out the company that is able to outperform. But if everything is driven up by excess supply of money, monstrous supply levels of money, then there's no point in being actively selecting, smartly selecting particular securities. Everything is going up. Are you able to follow this? Okay, I think we'll have to conclude now because people are getting restless. Okay, but we want 1 minute. Let's conclude the discussion. 1 minute, please. Don't get restless. Don't behave like kids. Okay, 1 sec. So this is the answer to Tushar's question. Try to understand this point. We won't have a chance to do it again. So this is why the monetary policy response to the GFC is very significantly responsible for driving the change, a movement of assets from active to passive. Is this clear?
Yes.
Try to understand this point.
Yes.
So I think, Sushant has definitely understood. Okay, you can go now. I owe you 2.5 minutes.
3 minutes round up. Round up 3 minutes.
So rounding is